You all for coming. This is like church. There's a lot of seats up here in the front. I know nobody wants to sit in the front, but my name is Michael Drury. I'm the chairman of the Global Interdependence Center, and it has been my privilege to serve for the last 3 years. But the reason that we are here today is that there is a changing of the guard coming at the Global Interdependence Center. And so as of I guess what, 5 o'clock, Jill, tonight?
Can't wait.
Okay, well, so New Year's Eve, we will have a new chairman, and he is here with us today. It is Don Rissmiller from Strategas, based in New York. He's one of our key sponsors and a regular presenter at our events. Prior to being at Strategas, he was with ISI in New York. And at Strategas, he is one of the founding partners. Our new treasurer is our old treasurer, Martin Heldring. Martin is on his way. Our new secretary is our old chairman emeritus, George Chichekos. George is right here. Everyone knows George at Drexel. Our Vice Chair of Programs is Kathleen Stephenson, who is with us here today. Kathleen's currently with Huawei, was with AIG, and before that, Aladdin. Is that correct? Yeah. Long time ago. And on and on and on. Chairman 4. Oh, our other vice chair is Peter Gold, who is in the room. There's Peter. And Chairman Emeritus, who is that? Oh, me. I think that's it for our officers, right? So, and the executive director, raised to executive director from the position of director of operations about 6 months ago, is Jill Fernito, the beating heart of GIC.
It does exist.
We're going to have 3 short presentations today, starting with me. I'm going to talk about the globally interdependent economy, and then Don is going to speak, and then Chris Whalen from, what are you called now?
Whalen Global Advisors.
Whalen Global Advisors will be speaking about credit and the bond market. My piece is called Our Globally Interdependent Economy. And I'm going to go through this pretty quickly, but it's the way I think of the world and part of the reason that I'm so involved with GIC. And what I'm really going to try to get you to think about is a different way to think about how the global economy works. Because to me, it is a global economy. And I've developed this way of thinking over the last 30 years, and it's my way of thinking, so it's the correct way of thinking. So I hope you will all agree by the time we finish. But I used to, back in the old days, work for Gary Schilling in New York and traveled around the country talking to various sectors. You'd go to Houston for oil and New York for finance and LA for defense. And there was a national economy back then. And I quickly realized in doing that basically New York and Boston and LA and San Francisco were the suburbs. There were the doctors, the lawyers, the business leaders lived. And where recessions weren't really recessions of unemployment. They were recessions of changes in the value of portfolios. And then there was the Rust Belt, the old industrial base in the center of the country. And then there was the Sun Belt, which was Phoenix and Atlanta and the developing younger cities. And the trick was the younger places didn't have institutional constructs that stopped them from changing, but the older area did, particularly unions. But I mean, the idea was that new ideas could develop faster in the Sun Belt. And the key to that model was that if you were going to look for a recession, you looked in the Rust Belt because that's where trouble came first. But if you're going to look for where policy made a difference, you looked in the Sun Belt because policy never mattered in the Rust Belt. There was no policy that you could adopt in Detroit that would save Detroit. It would just slow the demise of Detroit. Well, why is that all important to the Global Interdependence Center? Well, because now I don't do that anymore. Because if you drop me in a mall anywhere in the United States, I won't know what city I'm in until I find the hat store and see what teams are on the bill of the cap. Because they all look the same in the United States today. But as I travel around the world, I now think of the United States as the suburbs. The Rust Belt being old Europe and old Japan, Korea, Taiwan, and the Sun Belt being China or Southeast Asia in general. And the same model that I used to use for a national economy works for an international economy, and it works because there used to be national companies, and now there are international companies. And those international companies make decisions on where they're going to invest, where they're going to hire labor, where they're going to pay taxes, where they're going to pollute, where they're going to do everything independent of where they're going to sell the final good. So I break the world into basically 4 quadrants these days. There's the NAFTA quadrant, which is dominated by the United States, about $22 trillion, a little more than a quarter of the world. There's the Eurozone, which is about 19, and about 11 of that is the Eurozone itself. Then there's China and the commodities producers because they're very, very integrated. China's just surpassed the Eurozone at about $12 trillion. And then there's kind of old Japan, South Korea, Taiwan, which feed into the China part and the US part about equally and don't really touch Europe very much at all. Why is that important? Well, this is a national model. We used to have recessions that were very short and sharp. Then they got a little longer, and now they're really long. And they're always caused by financial crises. This is the RTC crisis, the savings and loans, the NASDAQ bubble popping in 2000, and then Lehman in 2008. And that's the way you all think of them. But that's not what they are. That's exactly the same chart. And the reality is that, 1990, the savings and loan crisis was caused by the Nikkei bubble, which drove up interest rates. And they backed up with higher interest rates into the United States and caused the savings and loan crisis. And 2000 was actually started by the Asian crisis in Thailand in 1987. And when Thailand collapsed, it ricocheted around the emerging markets, and that money came pouring home to the United States and caused a boom in 1998 that probably would have popped by 1999, except there was this thing going on called Y2K, where every business in the United States thought it would be out of business on the first day of 2000 if they didn't spend all the money that they could get their hands on. And that's the only time period in the history of the United States that businesses collectively have borrowed money from the household, the government, and the foreign sector. And then finally, Lehman, well, that was us. We did that one to ourselves. All of this happened where back in the early 80s and early, we basically didn't have a trade deficit. And then Japan came in, then Japan broke, then Asia came in, and now China's come in. And now even bouncing back after Lehman, we're running a 3% trade deficit all the time. People say a trade deficit is bad in a globally interdependent world. What a trade deficit is, it means you're the suburbs. Everybody wants to move to the suburbs. And when you go to move into the suburbs, you got to buy a house there. And you got to buy it from somebody who owns a house there. And you drive up not just the value of their house, you drive up the value of every house in the suburbs. And that means that everybody who lives in the suburbs can now spend more money than they actually earned because they have appreciation in their portfolio. And that's why you run a trade deficit, is because you're rich enough because of the appreciation of your assets that you can spend more than you earn. Because we don't talk about capital gains in the savings measures that we talk about. The next secret is our investment is their investment. We're about to pass a tax bill in the United States, and it's almost 99% assured that it's going to pass. And it's going to lower corporate tax rates. And the mantra that you will hear day after day on Wall Street is that now that it's lower, we're going to invest more in capital. And we probably are. But when you invest in capital in the United States, 60% of the dollars invested in plant and equipment in the United States go offshore immediately because we don't make that stuff. Meanwhile, if you want to increase capital goods production in the United States, if you want Boeing to sell more planes, then it's China that has to be booming. Because 60% of what we produce in the United States as capital goods, we sell to somebody else. And those have been rising, for years and years and years. That's the global interdependence. We've now interwoven these things where we were just down in Mexico and people are talking about NAFTA. There is no Mexican economy. 80% of what they sell goes to the United States. So what does this all mean going forward? Well, I focus on China, and I focus on China a lot because I realized 10 years ago that my 25-year-old son was going to grow up in a world that was dominated by China, not the United States. And it's not a philosophy that people are happy to hear about, but it's a reality that I've been living through. I first went to China in 2005 when it was a $2 trillion economy. Now it's 12. And it's not growing as fast as it used to, but growing at 10%, that means it basically creates a Ireland, Portugal, and Greece every year. I mean, it creates half of a UK every year. The importance of this graph is that it bottomed back here in 2015 on their corruption campaign, and then it rose, and now it's looking a little, I don't know. And that's important because if we look at what happened in the United States, that's 3 months after China bottomed. The UK, that's 6 months after China bottomed. Japan, that's 9 months after China bottomed. In the absence of changes in monetary and fiscal policy in the United States, Europe, and Japan, because interest rates have basically been fixed, locked, QE's been locked, there's been no changes in fiscal policy. There's one coming, but there haven't been any yet. It's policy changes in China that drive the economic cycle. This is the most important chart in my world. That's a chart of Chinese nominal GDP in dollars. What that means is buying power for oil, copper, corn, everything that's sold in dollars in the world. And China is the biggest purchaser of all those commodities. Memorize that chart where it goes up fast, crashes into Lehman, rebounds to the Japanese tsunami, then sells off, and now there's a little rise. That's the chart for copper. Rises, booms, falls, rebounds, falls away, up on the dollar. And this is the chart for oil, which looks the same till here, but the same tsunami that did this to everything else actually raised oil prices because the nukes went out until it broke, and now it's doing the same thing. So all the commodities are moving on China. Where's China moving? China's a 3-year roller coaster from 3% growth to 9% growth. Now they report 6% growth every quarter. And that's because if you belong to the Communist Party, you cannot admit that the market is more important than the party. And so they always say they're growing 6%, even though they're booming, busting, booming, busting. And we think that they were at a boom and now they're on the way to a bust. And this is the leading indicator, real estate in the top 17 cities, which has already got them down to 0. Why does this happen? A lot of credit, no credit, a lot of credit, no credit, a lot of credit. And we're hearing more and more that credit's being cut off in China. And so we think that's where the cycle is headed. The other thing we watch is the currency. When they're happy, the currency's appreciating. During Lehman, it stopped, then it went up again. Then during their corruption campaign, it came down. And now they've been happy, and now we don't know. So we're watching the currency very carefully to see what that means. The short-term cycle indicators in China, coming down, and coming down from levels that were as high as they were back here when they were growing 15%. We think that China might have been growing as fast as 15% nominally in the end of 2017, numbers that nobody else will talk about. But I can tell you, boots on the ground, you can see it over there pretty easily. Trade, same thing, bust, boom on the strengthening of their currency, and now starting to roll over, which makes us nervous. So why does all that matter? Well, it matters because, again, in this absence of policy, it's Chinese policy that matters. And in the absence of global leadership, it's Chinese leadership that matters. They've just elected their new government. And the argument was about who was going to run the country. That was never in doubt. It was going to be Xi Jinping. Was the number 3 man, Wang Qishan, going to retire? Yes, he did. Were new leaders going to be appointed? No, they weren't. And these guys are nice. They got promoted based on age. Doesn't mean anything. None of this means anything. This is what means something. There were 25 people in the Politburo. 11 retired. 3 were forced out. 1 was kicked out of the party. That opened 15 seats for Xi Jinping to fill with people that he liked or didn't like. 1 was in the military. He took that slot. 3 were vice premiers. He took 2 of those slots. 5 were in the general secretariat, which is like the cabinet of China. He took all 5 slots. 6 were provincial leaders. He took 5 of those. He took 13 of the 15 slots. These are the people who are going to run China in 5 and 10 years, and they all belong to Xi Jinping. No other party in the world, the communists in Russia, Macron in France, Trump with the Republicans, Merkel with the SDP and the CSU. Nobody has this kind of control over their economy. Of the 31 provincial mayors and governors, these guys are all between the ages of 55 and 60. These guys are all between the ages of 60 and 65. China moves on a military basis. You're on the colonel's list. You're either promoted to general or you're out. These are the people that are going to run the country. Everybody has been appointed, except these 5, has been appointed in the last 2 years. Every one of them. They all belong to Xi. He has more control over his party than anyone else. Why does that matter? Because he has programs in mind of what he's going to do to the world. The #1 program is the One Belt, One Road program. This is a program which is basically going to recreate the string of pearls in the Navy that the British used to have, but more importantly, is going to build a west coast of China and an east coast of Europe and connect them by rail, where you'll be able to go from the west of China to Paris or Rotterdam or any place in Europe in 3 days by rail with freight. Right now, it takes 45 days on the water to get stuff from Korea to the United States, 30 if you pay a lot of extra money. It takes 3 weeks to get from China to Europe right now. They're going to do it in 3 days. Think that will change the way the world looks? Yeah, I think that will change the way the world looks. They're spending untold money to do this. They don't care about profits today. They care about control of the world in 10 to 15 years. The second thing they're doing is pollution. The Chinese believe in climate change. They believe in climate change for a very simple reason. The old capital was back here in Xi'an at the base of the Himalayan mountains because in the 1300s we were at a period of much colder temperatures than we are right now. And so when this melted, this was the area that got wet. This area got swampy. Nobody wanted to live there. Then the world, much warmer temperatures. Then the world cooled down. And when the world cooled down, this area became the best agricultural area. And so they moved to Nanjing, my friend here is from Nanjing, south capital, and Beijing, north capital. This is where about 300 or 400 million of the Chinese live. If temperatures go up 4 degrees, this is all underwater. They don't think that's a good idea. They're not happy with that. So they're doing everything they can to get rid of pollution, primarily coal. And that means they're spending enormous amounts of money on all other kinds of energy, wind, solar, nuclear, gas. All those industries have wonderful futures because the Chinese are going to buy everything that you can make. And then the final thing is their stock market. Xi spent the first 5 years of his life in China fixing the real side of the Chinese economy, which was extremely corrupt, and you basically built stuff so that you got credit for building stuff, and it was useless. And he cracked down on that through the corruption campaign, and now you only build stuff if it actually makes sense to build stuff, and you close stuff if it makes sense to close stuff, more or less. It's not perfect, but mostly. So who's he going to fight in the next 5 years? Who's the real threat to the Chinese Communist Party in the next 5 years? It comes from 2 sources. It comes from finance, the amount of debt, and it comes from the technology companies, which are growing very fast and out of control of the party. So they're taking control of the technology companies by putting party bosses into the companies and taking golden shares in the company and forcing companies like Alibaba, Tencent, Baidu, JD to buy weaker and weaker partners to slow down their growth and broaden their base and make them more like the party itself, big conglomerates. The stock market, well, as you can see, the stock market went up, came down, went up, came down, went up, going up. They're making sure it's going to go up. By 2030, half of the stock in the world will be in China. And everybody in this room that trades stock is going to have to own Chinese stock whether they like it or not, because it'll make up half of the portfolio in the world. That's the battle that they're going to fight for the next 5 years. Is they've just started a super regulator. They're going to have the central bank, the bank regulatory commissioner, the stock exchange regulatory commissioner, the insurance regulatory commissioner, and the Politburo on top of that. Those 5 guys are going to run China, and they're going to make sure that Chinese finance does the same things over the next 5 years that happened in the real economy over the last 5 years. And for most people in the world who deal in finance, which is a lot of people in this world, that's the most important trend in the world for the next 5 years. So we live in a globally interdependent world where you're not going to be able to avoid sitting in New York or San Francisco or London what's going to happen over there. That's my story, and I'm sticking to it.
All right, thank you, Michael. I'm Don Rissmiller, and I'm happy to be here. I'm going to share a few thoughts on what I see in some of the financial markets currently. Obviously, we've come through a year that's been pretty good for risk assets, and I think there's a lot of talk that this could have something to do with the expectation of what's going on in U.S. policy, U.S. fiscal policy, and I think there is something there, but I don't really think that the rally in the stock market this year has much to do with DC or fiscal policy or Trump or those type of stories. What I do think it has to do with is a lot of what Michael's been talking about, that we had quite a good year in Asia, driven by China. We had stability in oil prices that was partly due to the actions of OPEC, and that has led to a nominal GDP story for 2017 that I think sometimes gets missed in the context of a whole lot of political debate over taxes or over healthcare or over a lot of things that are going on in Washington at the moment. So what I see is a world where the US dollar has been weaker, interest rates are low, the parts of the stock market that are tied to a fiscal policy bill like high tax versus low tax companies or companies with money abroad, that really hasn't worked. And so we have to make a decision about whether there's something wrong with that exercise or it's ahead of us. And what I'd like to leave you with is the idea that we still have global growth. Perhaps it'll be a little different next year, given some of the charts Michael showed you. But the Trump trade, this reflation trade, is still mostly ahead of us in the US. And so there's a handoff that I would look for from China and oil to a fiscal policy bill in the US. And so we're going to move from a world where China's having a decent year, oil stable, Japan had a very good year. There's some evidence deflation is ending. If we look at the Japanese GDP deflator, Europe's had a good year, and profits are up in many places, to a world where perhaps the US dollar could become an interesting story, interest rates could move up slowly, and we could see some of the parts of the market that are leveraged to US fiscal policy do a bit better. So in terms of U.S. growth, we are looking for 3% U.S. GDP next year. We think part of this is going to come about through deregulation, or at least more sensible application of some of the existing regulations. We're not looking for a repeal of Dodd-Frank or anything of that sort, but we are looking for moves at the margin. We are focused on what small businesses are going to do with the coming changes in some of the tax code items. We do think the bill passes. It's probably going to pass quite soon here. So we'll see how that shakes out probably in the next 2 weeks. With this backdrop, we think unemployment in the U.S. could be 3.5% as we get to the end of 2018. And so we are looking for more labor-saving technology, more capital spending, and we think productivity in that environment could move up to about 2%. Inflation should also be rising, but very slowly in that world. We think this is probably a perfectly good thing, given that we're below target. We call it more reflation than inflation at the moment. We do look for wages to rise. We looked at what type of wage growth really starts to hurt corporate profit margins. That number is around 4. We're about 2.5 today, so there's room to go there. I'd call this good inflation, at least for risk assets on the equity side. I do think the fixed income markets need to pay a little more attention, but our general view is the Phillips curve is not completely dead. It seems to work at the global level. It seems to work at the local level. We're just waiting for it to work in the middle, and I think that that's coming. And so a monetary policy picture, which does have some normalization, makes total sense to us. It should be gradual. We'll have a ECB taper that's going to start in January, but the Bank of Japan is still very easy, and obviously what's happening at the Fed is proceeding in a gradual pace here. So what we see is confidence in this world is elevated. If we look at the Conference Board measure of consumer confidence, it just hit a new cycle high in the U.S. on the consumer side. couple weeks ago. So I think this makes sense in a world where the labor market is healthy, you have stock prices going up, you have home prices going up. But it's not just the US. So confidence is also elevated abroad. And the way we try to tie this together is to say what we've had is nominal activity that has turned higher. And this is important for driving confidence both of households and businesses. So this was not always the case. If we go back to the 1970s or 1980s, it was very important to take inflation out of any measure you had. It was important to get to a real or inflation-adjusted metric. When inflation was high, that was absolutely essential. You would make a mistake by not taking inflation out. Since 1999, though, confidence measures have actually been more correlated with nominal activity rather than real. They're both decently well correlated. But since Japan taught the world deflation is possible, it seems to us important to also watch what is going on the price side. Earnings are nominal. Company reports are done in nominal dollars, as an example. So I just say don't ignore nominal GDP. Sometimes if you pick up the newspaper after a GDP report, you read the story, nominal GDP doesn't even get mentioned. I think that's something we have to pay attention to, because when inflation's very low, discarding it may be missing a piece of the puzzle that matters. As Michael said, nominal growth in the world is driven by China. It also it's driven by oil prices. So let's give OPEC a role there. But this has driven confidence up in the US, it's driven confidence up in Germany, and Japan also is having a good year. So I'll show you a few charts on this. This is the German IFO. So one reason I have this chart in here is to say I feel very confident German business confidence has nothing to do with Trump. Right? So if we're looking for what is driving confidence up, there is no way this has something to do with a US tax bill or anything in DC at the moment. It's hard enough to get a handle on what's going on in DC from here in the country. I'd say when I've been abroad, I feel a lot of people are punting at the moment. They say, we'll believe a bill when it's signed. Until then, let's talk about something else. So we see similar moves to this in some of the French data. We know we had quite a big rally in French confidence after the French election this year. But this, to me, would say this is much more about what's gone on with global nominal activity than it is anything on the US fiscal policy side at the moment. This is real GDP in Japan. So again, the shaded bars here are recessions. So in Japan, we had recession after recession after recession for quite a while. We've actually strung together a nice set of quarters here. And so potential growth in Japan is quite low. It's under 1%, probably closer to half to 0.75 in terms of what the economy should be generating. So for Japan to print numbers of 2% or so like we've seen in the past couple quarters is really quite good. It'd be like the US printing double our potential growth rate. So we have an area of the economy now, the global economy, that is performing decently well in real terms. And this is the GDP deflator in Japan. So this is just the price level. This is not a percent change. So what we see is prices fell for about 20 years. There was deflation for a long time. I think everybody is familiar with that. What we may not be paying attention to is in the last 2 years, we've changed. Price levels in Japan may have hit a number that's so low, we're not going lower anymore. There's a lot of policy being thrown at this. But still, I'd say it's somewhat of an accomplishment that even in Japan, the price level has stopped going down. This is another way to say global growth is probably pretty good in addition to the policies we see if this is the picture. There's a notable price level story that we should be paying attention to here. So the key for us is 2017 was about a global nominal recovery. That drove profits up. That bought quite a bit of time for the politics to play out in the US. And we've taken all of the time. We've had debates on tax reform or cuts or what we're going to do. I would say we're assuming we don't get a full monetary offset to any package that does pass, and we would throw trade policy out there as something we should consider. We could deal with that in the Q&A section if anybody is interested. But the handoff we look for as we go from 2017 into 2018 is for global growth, which has boosted profits, to turn into a story about how the three main parts of this corporate bill, which are the tax rate, the accelerated depreciation, and the money from abroad, will allow earnings to rise into next year as well. So the handoff on the baton is from oil and China to DC. Or the next step, the part that is still coming, is the story that people were starting to tell a year ago prematurely. The Trump story, the Trump trade, the reflation trade, the dollar trade, the rising interest rate trade, the high tax versus low tax company trade, all of that is still ahead of us. I would say of the tax bills that are out there, there's the House version and the Senate version. We're going to try to put these together over the next few weeks. The chances are high that a bill gets passed because procedurally, now that we have two to work with, the absolute worst case scenario for the current government would be that the House just takes the Senate bill and passes it. Again, that's not plan A, but that's why there's a 90+% chance that something gets done, because the mechanics have now gotten us to a point where if everything else went awry, the House could just take the Senate bill. What they want to do first is change the Senate bill to make it look more like what they're interested in, and that's what's likely to happen over the next few weeks. But again, I would second the idea. There's a very high percentage chance that a bill gets done, and probably quite quickly here. I'm less interested in the individual tax changes in this. I think some of that could wash out. The three things that I do think will matter is, do we get a lower corporate tax rate, and when do we get it? So the Senate bill, one of the issues is that it delays the corporate tax rate change to 2019. That's later than I would like. I don't think that's going to be a whole lot of fiscal stimulus right away. And that would reduce the impact of this bill quite a bit for next year, or it'd be delayed substantially. That's with a 20% tax rate. There's some talk of giving a little bit on that, maybe make it 22% or so. But it's still not clear if that 22% is going to apply to 2018 or 2019. So if there's one key question to ask over the next few weeks, or to see what this tax bill winds up looking like, it's, is there a corporate tax rate cut? What is the percentage, 20, 21, 22? And is that applied to 2018 or 2019? So the more it looks like the House bill, the more bang for the buck we're going to get early. The more it looks like the Senate bill, the more it's going to be delayed. But that's the setup at the moment. So that's one thing that we are looking for in this tax bill to be a boost. Then it's the accelerated depreciation provision, which we do think is going to help capital spending and bringing money back from abroad. And we're not convinced that has a huge economic impact by itself, but combined with the other two and as a provision for earnings, we think that those three together, taxes, depreciation, and money from abroad, repatriation, are where the action is in this bill. Let's call the rest of it a wash. I'm willing to do that. I'm going to say everything else that's a moving part we can say is a zero in terms of stimulus. Some people will benefit, some people won't. But I think a lot of the action happens from those three parts of it. And a critical item will be that the tax provision on the corporate side, the rate change happens in 2018, not 2019, to get the benefit immediately here. If we're going to judge how we know it's working or not working, I really think we could look at the capital spending side of the economy. If this is going to be a bill that's considered a success, I think it has to result in productivity going up. And that's a low bar at the moment, because productivity in 2016, if we look at the data, was 0. So we just did what we did the year before. We made no progress in aggregate and output per hour. So I think that there's room to go there. 0 is an awfully low number on productivity. We can't come up with a good conceptual reason why productivity growth in a stable, developed economy should go negative. Right? So you're at the lower end of what is conceptually possible. A trend productivity growth number would be closer to 2, maybe 2.25 over time. And I'd say a way to judge if this tax bill has any success is, do we get capital spending up, does that lead to productivity rising in the U.S. economy? I think that's the intent of some of these corporate provisions. But that will be a way to judge the success of this handoff. We have a nice runway. We have a good amount of global growth at the moment. It's synchronized. It's helping many countries. It's driving profits up in many countries. The handoff has to be to a world where the U.S. also plays a role. And I think U.S. growth can move to the upside, but it has to go through that capital spending and productivity channel. So I'll stop there and turn it over to Chris Whalen.
Thank you, Don. Good morning, everyone. It's great to see everyone again here in Philadelphia. This morning, I'm going to talk a little bit about the credit markets and the Fed, and I'm not going to use slides because I hate slides. It's always better to just talk to everybody. Years ago, Jim McGregor from Abernathy McGregor said, "Chris, you want them to remember you, look them in the eye, don't use slides, and work people and maybe even a dog into your story." And, you know, it's sage advice that I've used over the years. I'm going to talk about two things, really, a little bit on China and a lot on the Fed, and how the narrative that we hear, the narrative that we all participate in as analysts and observers of the financial markets and what's actually happening are not in sync. And I can't think of anything better than China to illustrate this. I did an interview a few weeks ago on my blog with Lee Miller, who publishes China Beige Book. And he said, "Chris, you know, it's so amazing. Last year, 2016, when the first quarter came and the world literally fell off the edge of the table because they were worried about China, and the ABS market stopped and the high yield debt market literally stopped. You know, everybody revised their views and said, no, China's not going to grow as fast as we thought. By the end of the year, though, when it became very apparent that the coronation of Xi Jinping was going to proceed without interruption or surprise, and that they were going to spend whatever money it took to make that happen, all the Western analysts got bullish again. And they all revised their estimates and said, oh yeah, 7% easy. I think one of the risks we face, going forward next year and beyond is that the financial markets don't recalculate their location on the grid very efficiently. And a lot of them are probably going into this year thinking that China's going to look the way it did in 2017 and 2018. If the deceleration that Michael is talking about, and which a lot of our friends are seeing, is as real as we think it is, turning down that political gas that they used to make sure everything was great and that there was no surprise, could really surprise Western analysts, I think. It could take the markets by surprise. It could cause a correction in U.S. stocks, for example, and it could send another ripple through the bond market, particularly things like asset-backed securities and corporate bonds, which have been, going great guns. We've had record issuance in corporate bonds for 5 years in a row. What were they doing with all of that money? They were buying back stocks. We've taken over $3 trillion worth of stocks out of the U.S. market, all funded with debt, thanks to our friends on the Federal Reserve Board. So if China slows and everybody is quote-unquote surprised due to that fact, you could see a fairly negative, at least short-term impact on the markets. We'll see. But I am impressed as a student of China by some of the non-economic things that Xi Jinping is doing, moving large itinerant, quote-unquote, illegal populations away from the cities closer to the coast, moving them inland to the empty cities that they've been building for the past 5 years to replace Western export earnings. There is a limit to state-inspired economic activity, and they could spend as much money as they want, but the one dynamic that's missing in China is freedom. And sure, they allow a little freedom in the real estate sector and here and there, but ultimately the party is in control, as Michael was saying. And I think the big point of vulnerability in China is just that. Their certainty that they are in charge, that no one can challenge them. If you've read Chinese history and you go back 10 centuries and look at why things have changed suddenly and for rather mysterious reasons, that's kind of what I expect in China. Something that no one expects, but which nonetheless has a really significant impact. You know, the last really big conflict in China other than World War II was the Taiping Rebellion, which started because there were rumors of foreign missionaries eating children. And it turned into a conflict that was larger than the US Civil War. Okay, just to give you some scale. And it started from the periphery, worked into the center, resulted in a change in governance in China that was rather earth-shaking, left a very weak monarchy after that, and then subsequently you had World War II, the Japanese invasion, and finally the rise of the Communist Party. The Chinese Communist Party is the last legacy party from the Cold War. So that's one of the reasons I don't think they'll survive. Switching gears, let's talk about the Fed. I just did an interview with our dear friend Bob Eisenbeis, who was head of research at the Atlanta Fed. And when we started our discussion, we were talking about the new Fed appointees and what we expect to see from the central bank. And he made this amazing remark. He said, you know, Chris, there's this steady drumbeat, this chest thumping by people at the Fed because they're so proud that they made money on quantitative easing. They were so deathly afraid that they would take a loss and they would get in trouble with the Congress. Some of you may recall that the Fed had to work out a special deal with the Treasury. If they lose money on the securities they bought during quantitative easing, they have this special little box over here where they can hide it, and they don't have to take a charge against capital. Now, why is this significant? Well, you may recall the Congress confiscated part of the capital of the Federal Reserve banks and put a cap on it. And they use that for highway funding. This is America, after all. And members of Congress love to spend money. And when they can't spend it one way, they'll find other ways. And it shows you kind of the wonderful third world quality of the United States. We're still very much of a developing country, despite all this nonsense we hear about central bank independence and industrialization and everything else. Our members of Congress haven't changed at all from 100 or 200 years ago. I could remind you of Mark Twain, but we don't have time. So, you know, what I said to Bob, I said, wait a minute, that doesn't matter. What matters is, did the policy help the economy? And is the unwind of this policy going to have deleterious effects on the financial markets? And he said, oh, no. They're going to take their time and be very careful, and they're not going to sell any of the mortgage securities specifically, because they know that about 20 billion or so is going to run off every month. And if they just wait for them to mature, they don't have to take a loss. And I said, but wait a minute, are you telling me that they in fact are going to tolerate a flat yield curve next year and maybe even an inverted yield curve? And he said, yes. Now to me, working in the bond market, this is rather incredible, because the one thing about central banks is that when they go out and they invest in securities, they don't hedge them. If I'm a bank and I own a bunch of Ginnie Mae mortgage bonds, I hedge them because I don't want to take a loss. I have to hedge the risk that those securities, which might be priced against a 5-year note one day, could extend if rates are going up, and suddenly they're priced against a 10-year bond, and the price has gone down. Extension risk is the way that most of the big financial crises in this country have started going back 30 years. Remember Kidder Peabody? Remember long-term capital management? All the rest of it, right? It was a lack of understanding of what the true characteristics of a mortgage-backed security were and where it should really be priced. So here's the Fed. They own all of the recent vintage mortgage securities, Fannie Mae 3s, Fannie Mae 3.5s, and they're sitting there on their book. They're not hedged, so there's no selling pressure to raise long-term interest rates. So as the Fed raises Fed funds, what's happening to the 10-year bond? It's going to start going down again, the yields. It's going to rally because the Bank of Japan, the European Central Bank, the Fed, none of them hedge their book. And this is $20 trillion worth of government securities, mortgage paper, and corporate bonds, even stocks. So we're in this kind of conundrum. On the one hand, it's clear to me that our friends at the Fed in New York and many people in Washington understand this. They say, yes, the yield curve is certainly flattening. But because of their petty bureaucratic perspective in Washington and the fact that the Fed does have to live with the Congress and they do have to deal with politics, and they don't like dealing with politics, they don't like being criticized by members of Congress, the Fed may indeed just sit there, go down the dot plots and continue raising the Fed funds rate, even as the long end of the bond market rallies and yields fall. Now, I'm not saying that this is going to bring us to the apocalypse. Far from it. I think the economy is doing well, largely because it's doing well. I don't think policymakers have had a whole lot to do with this. I work a lot in the mortgage industry, and I can tell you productivity hasn't gone up in the mortgage industry, Don. In fact, it's been cut in half. So if you want a really big piece of that puzzle, you look at the millions of Americans who work in mortgage finance, and it now takes 2, sometimes 3 executives on the floor of a mortgage servicer to take care of a borrower that one used to take care of. Okay, that's negative productivity. But overall, I think the regulatory burden has a lot to do with why the economy hasn't been growing so fast. There are other factors as well. But the key thing for me with the Fed is, you always go back to the paraphrase of the Hippocratic Oath, first do no harm, right? The Fed, in good faith, bought all those bonds because they thought it was going to help. They wanted to affect income, and Janet Yellen worries about households. That's really her sole focus. But unfortunately, they were successful, just not in the way that they thought. Inflation's up. You could see it in the stock market. Inflation's definitely up in the housing market, and it hasn't helped home buyers. It's been a seller's market. In fact, I would tell you almost all the benefit of the Fed, the FHA, and the way they've dropped their premiums and every other things in Washington has been to help sellers. This has been one of the most remarkable sellers markets anyone's ever seen. But the thing that scares me is what I call the Yellen inflation, which is quantitative easing, may be permanent. And those home price changes that you see on the coast, that you see down in Texas, even southern Florida, I don't think that's going away. There's a lot of scarcity of assets that we also see in the bond market. And there's a lot of other factors which tell me that this shift in asset prices that was orchestrated by the Fed and the other central banks may be here to stay when we talk about real assets like housing, commercial real estate, multifamily real estate in particular, which has the regulators very worried because the prices have been going up double digits for 5 years. Banks aren't losing money when multifamily assets fail today. The loss given default is negative, which means they pay off the whole balance of the loan and they make money. That's how much those prices have gone up in 5 years. So when I look at the Fed and our new chair and the other governors who are coming on board, they're inheriting this policy mix, which is driven partly by a desire to be helpful to the economy, and I think very genuinely so, but they're constrained by this inside the Beltway Washington politics, which says, I'm not going to sell any of the paper I need to sell to make long-term interest rates rise as I increase short-term rates, so I have a more or less normal yield curve. And in fact, I'm going to sit on my hands until 2023 and wait for this paper to run off. Well, I'll tell you something. If they invert the yield curve, this economy is going to stop. And the reason is that credit spreads for high-yield borrowers will widen. They've been very tight for years. You actually shifted the entire credit curve in the U.S. bond market so that inferior, double B companies could raise money at triple B or single A prices. That's really what they did. And you've had enormous debt issuance as a result, as I mentioned. But I'm really worried. The one thing I am worried about is that the economists, and don't take offense, boys, who populate the Fed and who dominate their discussions don't spend enough time worrying about the impact of their policies on the bond market. Because ultimately it is the bond market, housing finance, consumer finance that are the transmission belts for policy. And if you don't very carefully understand what is going on in those domains, and you take your eye off the ball, and you wake up one morning and the yield curve is negative 10 or 15 or 20 basis points, you're going to see a sell-off in stocks, and you're particularly going to see financial sell-off. REITs, banks, anybody who's in the world of leverage is going to be affected by that. And I don't know politically how they're going to extricate themselves from this, because it would require that the Fed kind of publicly say that they messed up. And if you know anything about the Church of Rome, they never admit fault. Thank you.
Okay, so we're going to take some, what? We're going to take some questions from the audience. Start with Peter Gold.
So thank you, all great presentations, thank you very much. I did have one question that anybody can answer, just in terms of looking at the proposed legislation in Washington, whether it's Don or someone else. You define success as capital spending increasing and productivity increasing. What about wages? Even though unemployment is, quote, at a historic low, actual wage increases have not paralleled increases otherwise in the economy. How do you see wage levels in the United States? And if we want to increase somebody's wages, are we actually increasing the wages of the folks in China and Asia?
Yeah, so thanks, Peter. So let me make a couple points. There's this whole debate on the Phillips curve that we touched on briefly. And Mark Carney gave a speech at the Bank of England back in September talking about the global Phillips curve. So I think you're right that there are certainly global influences. And the evidence is that Phillips curve works at the global level. There are some separate studies. Dallas Fed did one, the Board of Governors did one, that the Phillips curve works at the local or metropolitan area within the U.S. So we have evidence it works up here and it works down here. It just hasn't quite worked in the middle. So I find that a little hard to believe that it won't ever work. There's some evidence that you have a kink in the Phillips curve, so unemployment above average doesn't do very much. Once you hit the threshold where you go below average, you get a lot. It's this nonlinear looking picture. So maybe there's something to that. There's also a debate on which wage series we want to use. So average hourly earnings could be affected by retirements, because you're getting an average of an older worker that's retiring, younger workers coming in, maybe at a different pay scale for a few years till they get up to speed. Something like the employment cost index should adjust for that because it fixes the job. But even that may not work if we have promotions within a company, so you don't necessarily move job grade to job grade if there are new positions that are created. And that could be happening in the tech sector or something where there was a new position that didn't exist, say, several years ago. The Atlanta Fed has a wage growth tracker. For what that's worth, that's one you can look at to see wages rising. But there's little question, no matter what we look at, wage growth has been slow. Let's take three variables. Inflation's been low, productivity's been zero, and wage growth has been weak. Of those three variables, I would say we have two problems. In other words, if we accept inflation's been low and productivity's been zero, there is no independent problem on wages. Right? Wage growth, if you were to add the sum of inflation and productivity, is about where it should be. It's weak. Right? So I'd say of that set of three items, we can have two problems, but not three problems. Right? So I guess I look at it as inflation's been very low. Some of that could be transitory factors. If we look at telecom services, that's probably going to wash out the numbers. There are a few things in there that look like they are one-offs right now. And productivity's been terrible. So I guess my pathway to get wages up is to get productivity up. With unemployment where it is, the dollar of GDP we generate should go more to labor. Early in a business cycle, when unemployment's high, a dollar of GDP is going to go first to capital. Later in a business cycle where we are now, with unemployment low, the dollar of GDP we generate is going to go more to labor. And what I want is to pay labor and capital, not labor or capital, because that'll keep the cycle going. And the way to do that is make the pie bigger. And that's why I'm so focused on productivity.
If I could, I think part of the problem is that economists believe that just getting investment up is going to result in an increase in productivity. And that may or may not be the case. I think that, inventions and innovations are lumpy things. If you look at 100 years ago in this country, the amount of innovation that was going on, it was transformational. The internet, that was transformational. But then we get a lot of incremental change, and they throw a lot of money at it. Or look at the investment that my friends in the mortgage industry have spent for the past 5 years billions of dollars on nothing but compliance. Banks, billions of dollars on compliance. For what? It's probably actually slowed down credit creation. So, you know, you have all of these different flows of investment, but I'm not sure a lot of them are really giving you leverage in terms of creating opportunities and jobs. And frankly, when a lot of companies have to expand productivity, they go offshore. That's, you know.
Kathleen?
Just as a follow-up, and again, thank you all three for great presentations. But a follow-up on this, we also have noted that after the Great
Kathleen,
Recession,
could you speak up just a tad?
sorry, after the Great Recession, consumption out of wealth is not what it used to be. And so you have that dynamic along with low wages, and on the other side you have.
Oh, thank you. On the other side, you have corporations that are cash rich. So how do we bridge this notion that a cut in taxes will automatically bring about an increase in investment when demand as such might not be as guaranteed, if you will, as one would have anticipated?
Yeah, let me give you a few thoughts on that. So I agree, we've been through a period, we're in year 9 of the cycle now, so we've certainly been through a period where there's been changes in behavior. We have not had the financing mechanisms. A lot of the wealth effect went through the home as well as the stock market. We had homes underwater. It took a long time to get out of that position. Just now are we getting out of that position, but certainly we have had no financing of the sort, the mortgage equity withdrawal, the cash out refi. I mean, that's, as Chris has said, that's been dormant, if not dead. So I guess that's different. I'm not sure if it's good or bad. I would say it's why we have consumption running around 3% annually. If this were 10 years ago and unemployment were low, we'd be at 4. If it were 20 years ago and unemployment were low, we'd be at 5. So to some extent, I'd say the 3% consumer spending we are getting looks more durable to the extent it's not underpinned by leverage. But the lack of all leverage probably has been a headwind. I think the question is there any incremental change there at all? Maybe not, but in any case, I guess I'd just point to that in terms of wealth effects. Then on the capital spending side, I think it's not automatic. That's why I'd say the way to gauge whether this bill is a success, I'd say, is if we get this. But I think it's the interaction effect between those three pieces. It's you change the tax rate, you say, I'm going to give you a government incentive to do your CapEx now, which is the accelerated depreciation provision. And I'm going to let you bring the money you made that you're cash rich with back from abroad. And so if you need a way to get your earnings up, that'll help. So I think corporate executives have been buying back stock because it fulfills a lot of their check boxes. Earnings go up, things of that sort work. Here's a way where you could have the government at your back for CapEx plus get your earnings up for at least a period of time. Or I guess what I'd say is it looks to me like the purpose of this bill is to say to companies big and small, this is your window. Right? This is, if you're going to do an expansion, if you're going to do CapEx, you're going to have a window, 3 to 5 years of expensing, a tax rate change, a period where you can bring money back from abroad. So if there is any pent-up demand, I would say this is the type of thing that I think would get that expressed at the corporate level. I'm much less interested in the individual side of this legislation at the moment.
You know what's interesting? This is again an illustration of how the narrative that's been developed by the media and the economics profession doesn't jive with the way a corporate treasurer looks at this. If I have an opportunity to invest today, what's my cheapest dollar? I go into the debt markets. I get to subtract that from my taxes. I'm not going to use cash. This isn't a cash problem. All of these big companies are hiding cash offshore. It's tax arbitrage. They do sale transactions and pretend that they're, sheltering assets when in fact they're hiding income. If you're interested in this, look at the Dow Chemical case that the Supreme Court declined to review at the beginning of this year. It was all about an offshore sales transaction which the IRS disallowed. They said this was not a true sale, this was a fraud, you have to pay us taxes on this. There's been several other cases, one involving GE and one involving a company called Overseas Shipholding Group that had to file bankruptcy because they had to restate their earnings when all of these offshore deals were disallowed. So yeah, you bring the cash home and you have to give it back to your shareholders. But it's not the most efficient way to fund investment if you're the treasurer of the company. And again, I think the question is, what are they investing in? Do they have something that's really going to drive earnings, is to me the question.
In the back of the room?
Yes. Actually, I had a question about the trade policy risk. I mean, despite the emphasis on China at the beginning of the presentations, North America still accounts for a quarter of world's GDP. What happens if NAFTA goes away, for example? And what effect would that have, not just on North America, but on trade policy with other countries like China?
So we were down in Mexico City about 2 months ago, October. And we had some really great conversations with people in the Mexican government. And I would say that at that time, they were fully prepared for NAFTA to go away. And part of their argument was that when NAFTA came in 20 years ago, there was a huge difference between NAFTA rules and WTO rules. And over time, as the world has opened up, that gap has narrowed greatly. And so if NAFTA were to go away, you would fall back to WTO rules. And for most of the industries in Mexico, that would mean tariffs went up somewhere between 3 and 5%. Some would get killed, but for most industries, you're talking about a 3 to 5% bump. And they estimate that that would be handled much like a border adjustment tax with a one-time adjustment in the value of the peso. And they've been through 20% changes in the value of the peso in the last year. So they don't see how that's going to be the ripple that starts dominoes falling. They're not happy with it, but they don't see it as a critical factor. They, like the Canadians, are much, and in Canada that's not true at all, because in Canada you fall back to a free trade agreement that's exactly the same as NAFTA, basically. So there's no change for the Canadians. What they're all worried about is that the world's moved on since 20 years ago, and there's a whole bunch of stuff that's not covered by NAFTA that they all want to talk about. And that's, I think, really the more interesting discussion on where things would come down, is how some of those industries, like telecommunications, would be handled if new tariffs, new laws were to go into place.
I don't necessarily agree with some of the comments you made. I think it could have a significant impact on US-Canadian relations. And if you look at an industry like the car industry, when the average car goes backwards and forwards across the border 6 to 8 times, and so many US companies are very well integrated with Canada, it could have a significant impact. I mean, just Pennsylvania alone, a third of its exports go to Canada. That's more than the entire European Union. It's 3 times what we send to China. I wouldn't be so sanguine about the risks of that.
Well, so let me.
Excuse me, just point out 1 second. Gentleman is making comments is with the Consul General's Office of Canada.
Yep.
It's been a friend of the GIC, so he knows the Canadian-US relationships fairly well.
Well, so part of the issue is, can we believe what the government's telling us? So again, when we were in Mexico, cars are a big deal for the Mexicans, obviously. One of the arguments for the Americans with respect to Mexican car imports is that the Chinese have started sending goods into Mexico, which get incorporated into a Mexican car, and then imported into the United States, thus avoiding the tariffs. So the argument was that, well, we're going to pass rules that make it harder for the Chinese to import parts into Mexico. Then Trump went to China, and what's the first thing he gave away? He gave away car imports from China into the United States. So it's very hard sometimes to believe where we're going to end up on some of these policies. I guess my view is sanguine because I think the car industry is big enough to take care of itself in Washington, and that at the end of the day, that's Trump's base, Michigan. He can't afford to lose that state. He's not going to pass something that would, any more than he's going to pass something on coal that would cost him that part of his base. But I'm an economist, not a trade specialist.
I spent a lot of time working in Mexico. I think the president should just abrogate the treaty now. I mean, the Mexican president. you know, and show the gringos what for. Because Trump, Michael's right, Trump has to cater to his base, but they rattle the saber more than anything substantive. They certainly didn't get tough with the Chinese, that's for sure. But we'll see.
Stan?
Michael, I wanted to ask if, given your prediction that, not prediction, your observation that China's growing without any concern really for profit, and this issue is global dominance. What do we do in a situation like that where there's no profit motive for them, it's just growing, and they obviously have the resources to continue that growth ad infinitum? Does that put, if I remember my old Marxist Leninist literature, is at some point communism will cover the globe, and where's this going? I mean, how do you sense its inevitability as it grows?
Well, so you're right that they don't have a profit motive, they have a growth motive, or they have a control motive. This is why when Chris was saying, slow down in 2018, Wall Street has this almost universal view that now that Xi Jinping has taken control and is complete control of the Chinese government, that he would do what they would do, which is that he would make the economy operate more efficiently and make more money. And that's what a capitalist would do. But there's not a capitalist body in Xi Jinping's body. He wakes up every morning like any leader of the Chinese party should and asks himself, what do I have to do to make sure that the Chinese party is in charge of China at the end of today? And if that's reform, he'll do reform. And if that's repression, he'll do repression. All you have to do is look at, Zhuangzi through Tiananmen to, that's capitalism is not their issue. It's just a way. So they're going to go for this growth. So how do you control it? Well, you have to compete with them. They're trying to go into Pakistan right now. There's a $14 billion package to build a big port, Gwadar port in Pakistan, and it's not going forward. And it's not going forward because the Pakistanis can't see the deal from their point of view. And the Chinese are pushing back and pushing back. So the question is, for China to expand this communist party, other people have to want to accept it. And if they're willing to, then it will expand. But if they're not, then that's where the rubber meets the road, is when do they run into parties who are not just willing to accept the money without any control. And in a growing world economy, it's harder for them to grow. But if there's another recession, global recession, it'll be easier for them because they've got a lot of capital and they've got, a lot of potential to go into places and help out. Are we going to do that? Are the Germans going to do that? Are the French going to do that? Is the EU as a whole going to do that? I mean, your specialty is Africa, and there's no competition there. The Chinese go in, there's nobody else there. Yes, sir.
Question, a little independent of the comments today, but just with the tax bill potentially becoming law, deficit spending, unfunded liabilities, Japan, sort of theoretical question. In a fiat currency system, is there in theory no limit to the amount of debt on the books or off the books a nation state can carry? I'm particularly fascinated by Japan and where we may be going. As long as the system holds, can you just continue to deficit spend your way?
So before the debt professional says something, let me, as an economist and a storyteller, I have a story on everything. And so my story on debt is what I call the paradox of debt. In China, when I first showed up there in 2005, interest rates were around 25% a week. It was what I called Vinnie the Nose money. And the reason was because you didn't borrow in China. Nobody borrowed in China. You basically only borrowed to get over weekend or over month end or, for some short period of time. And so you didn't care what the interest rate was. All you cared was that, you could pay the VIG and get through the deal. The opposite end is Japan, where there's an enormous amount of debt, so much debt that nobody could pay the interest on that debt and not go bankrupt. And so interest rates, as you accumulated more debt, interest rates had to go down and down and down and down and down until now you're at negative interest rates with the most debt in the world. And that's the paradox of debt. Now, it doesn't happen overnight. It takes you years to get into that position. And my argument on debt is that we're not going to get rid of this debt anytime fast. So when I talk to people and they tell me long-term interest rates or even short-term interest rates are going to go up quickly, I'm like, it's the weakest link in the chain type argument that I don't know who's going to break. But if you put interest rates up 100 basis points on the short end over the next 12 months, somebody's going to have a problem. I don't know who it is. Maybe it's Italy, maybe it's Greece, maybe it's, there's a long list of people. Maybe it's somebody I have no idea. But I guarantee you somebody's going to have a problem in that environment with this much debt. And then the question is, how does that domino?
Well, you're right. The detachment from gold allows the issuer to, emit as many fiat dollars as they want. And the reason we did this originally was the Civil War. Lincoln entered Washington. Most of the conscripts were going home, and they had to figure out a way to finance the conflict. So it's usually a function of war. If you go back to Rome and Greece, most great societies have debased their currency to finance wars. The kings of England is another great example. But, Michael was just outlining it right. I mean, the Japanese are in the most extreme position. They have to monetize their debt. There's no other way out. They will consume all of their savings, and they will get inflation up, as he was pointing out. And I think it could get quite difficult. The biggest problem for Japan is demographic. They are disappearing. So unless they can do something to change that trend, and I'm not sure you can, the biggest problem in terms of demand and inflation is the lack of Japanese people. They don't even invest at home. All the big Japanese corporates invest offshore. Europe's in the middle. Europe has a debt problem. It's not that severe, but it's getting there. And then the US is slightly better off. So it really depends, as Michael said, what is the rate you have to pay on the debt? I don't know that this system can really withstand a sharp increase in cost of funds, because then that shift I talked about before in credit, you will start to see the inferior borrowers who got better terms, and they will start to default. In fact, I would tell you right now, default rates on most asset classes are very low, but they should probably be 2 or 3 times higher than they are now. And it's only the central bankers who provided that nice warm blanket to hide all of this for a while.
Hi. With Brexit looming over the Rust Belt, as you called it, Michael, how do you think that will affect the European economy, and in what industries and where do you think we will see the ripple effects in the US, or do you think it will continue to be business as usual?
No, so I guess the way I look at the world is the U.S. was the leader and U.S. manufacturing was the leader, and so they recovered first. But as costs started to try to go up at all in the United States, we started to look offshore, and there was plenty of growth in the Sun Belt in China and places like that. But as those costs started to rise, then it finally ended up going back to Japan and Europe, and that's why they came on with a 3-4 year lag to the rest of the world, and why you have almost universally good numbers in Europe right now, and it'll probably stay that way for a while. But if and when a cutback comes, you're not going to close the plant in Doraville before you close the plant at River Rouge in Detroit. I mean, you're going to close your highest, the last in is the first out. So Europe's where, if we run into trouble, if this China slowdown sends a ripple that goes through the world, it's going to hit Europe way before it hits anybody else. And so that's not great protection for Cleveland and Detroit, but that's protection for Cleveland and Detroit. And we had a global recession in 2015 that probably nobody in this room knows happened. And that's because it didn't affect the United States at all. We slowed down to 0.75% growth, and the stock market didn't miss a beat during the entire time. But basically what happened is in 2014, when Xi Jinping took control, he had a corruption campaign, and he cracked down on lending and expansion in China, and it slowed down, and that very quickly backed up through the emerging markets commodities chain and caused a recession in the emerging markets, and they stopped buying capital equipment, and that backed up through Japan and Europe, and they all took recessions. And the reason you don't know about it is because they all devalued by 25% or in that range. Canada, I think 15, Mexico 15. And everybody devalued, so the value of their labor went down until they were viable again. And then they came back, and the United States didn't see any of it. We imported deflation, it kept our interest rates low, and we missed it. That's kind of what I'm looking at in 2018. But the reality is the second time you do something is never like the first time you do something. So I think the Chinese slow down for their own reasons. That backs up through the EM, backs up into Europe. I think the United States may get another pass. And for me, it gets particularly interesting because right when it will be the worst is when the tax package will hit. So it may be like 2001 through 2003 where the economy was pretty weak, but we had tax packages that gave it a little oomph and kept us from being in recession at that time.
Hi. So, I'm sorry.
I'm just looking for another, next in line. Go ahead.
No.
No, you go ahead. You go ahead.
So, thank you for all of your presentations, and I have a particular question for you, Michael. And since like you highlight about the prediction that on the Chinese economy probably by the end of its completion of the One Belt One Road project in 2049. But from my point on, I read stats like from the United Nations back to 2013. They released reports that in 2040, the biggest three economy entities, EU, United States, and China, the China will has the most serious aging problem. So that definitely will have the impact on its economy, labor market. So I mean, do you think that's where the U.S. like the chance like to stand up again, like or there may be like a big pitfall by the middle of this century for China's economy?
So for me, the Chinese demographic issue, I get this one a lot. The difference between the Chinese demographic issue and the American or the Japanese or the Italian, because it's actually I think it's the Italians and the Germans go first, the Japanese second,
Yeah.
and then the Chinese are worse than all of them. But the trick is the guy who's retiring in Europe or the United States has almost the same productivity as the guy who is coming into the workforce in the United States. And so if your population is declining, you're losing actual product. The guy who's retiring in China has a fraction of the productivity of the young person who's coming into the population. So they could actually have population decline 10% a year. And with 10% higher productivity from the ones who are coming in, they would be flat. So I think China will continue to grow. It will slow down. I mean, China used to grow 15, now it grows, now they say 6, and I think on average it grows 6. Someday it'll grow 3 or 4, like Korea does now. And it's probably not a long time in the future, but it's far enough away that it's beyond I have a 2-year crystal ball. And there are a lot of long-term things that will go on, but I work in the finance industry and nobody wants to hear about them. They want to hear about the things that will happen in the next 2 years. One more question? Okay, I'm going to take 2 more questions because they're both board members, and I don't want to get in trouble because I got a board meeting following. So I'm going to start with Bill and then finish with George.
Michael, why would you say that the productivity level is, I don't need it. Okay. Why would you say the productivity level is the same in the U.S. for someone leaving and coming in? And the other comment I'd like you to make is, would you comment on Elon Musk's deal in China?
Okay, well, so the productivity argument, I mean, I think you can tell this through wages. I think the problem with wages, personally, I think the problem with wages is a bathtub model. I think this is a classic aggregation problem. Wages are rising for almost everyone in the United States, and they're rising about 3.5%. And we know that because there's a bunch of individual measures like the Atlanta Wage Tracker, where they go out and they say, Stephanie Mackay, what are your wages doing? And they ask individual people, and they all report that they're making more money. But what's happening is that people my age, I'm 62, I just turned 62, so I could retire like most Americans. I won't, but most Americans retire at 62. At 62, that American retires. He was very well paid for his nascent technical skills because they were rare when he was 35. Today, the young kid coming in, my son replacing me, is not paid nearly as well for not just the same level of skills, but skills of that more advanced nature, because they're so broadly held by kids today, because so many more of them are college educated, et cetera, that the wages paid to the guy going out for his productivity and the wages paid to the kid coming in, maybe that's not a change in productivity, but it's reward to productivity, I guess is more what I'm looking at. So makes it tougher for the economy to grow from greater skills. George,
So
you get the last word.
question is, given this picture that all of you could, outline, when we travel abroad next year, should we hold dollars, expecting appreciation, or should we be long on one, or euros or other things?
All right, so I'm not going to say which currencies you should be in, but we're going to Zurich, so there are Swiss francs. Then we're going to Frankfurt. Those are both in February. Then in May, we will be going to Paris and Madrid. Those are both euros. Later in the year, we will be going, in February, we're going to Argentina. March, we're going to Argentina. I actually like the Argentine currency. I think Macri's doing wonderful things down there. But, and then hopefully we'll go back to Mexico City. Maybe we'll go back to Dublin, and maybe we'll go to China. But so I'll just name the countries we're going to. I'm not going to speculate on currencies.
For the dollar.
That's for these guys.
This is not the prediction. What is the forecast for the dollar?
Well, look, the dollar and the interest rates have been largely, the connection's been largely severed. If there was one recently, I'm not sure there was. Less liquid currencies tend to be a function of short-term interest rates. The dollar, no. The dollar's been a capital flows story. And after the crisis, all the money came back here, even though our rates were very low. They weren't as low as the Japanese or even the EU, but they're very low. But they came back here to go into real estate and stocks. It was capital flight. They were scared. They were in inferior venues. In fact, think about this for a minute. What's the real value of Bitcoin? It's for somebody who lives in a country that is dysfunctional. Like I have a friend in Lebanon who's been in Bitcoin since day one. It's a means of exchange in a country that doesn't have a government and where you have to pay for everything directly. There's nobody to pay. You got to contract everything on your own. So I think, these flows that determine the currency values are really, compared to what? So recently you saw a lot of money flow back out into the emerging markets, Argentina, like Michael was saying, back into China, even Japan, God help us, right? So to me, it's the investment flows that are driving it. It's hard to gauge. If I figure it out, I'll call you.
Please.
Final comment?
Yeah, I just end up by saying, look, we got a whiff of this Trump trade, maybe from November and December of 2016 to January. It was stronger dollar, higher rates, parts of the market leveraged to taxes that worked. Then we gave it all back. In fact, the market's gone the other way for most of the year. So I guess I'd say that it seems to me like there was a bit of a market tell in what worked on the idea that you would get a tax bill passed, but then politics came in clouding policy. And so I think if we actually see a signature on a bill, there's going to be more international interest in those type of trades. But I think we'll know in 2 weeks. I think we'll know very shortly here.
Well, thank you all for coming. We have lunch and you can ask questions right after.
It was just the second part, the Elon China question.
Oh, I don't even know what Elon did in China. What did he do?
He got a special deal.
Of course. Well,
Okay.
when Tesla defaults and he has to hide from his, when Tesla defaults and he has to hide from his shareholders, they're going to have a little house for him. That's where he's going to go.
But he got in without the government connection and relationship.
Well, the Chinese, if you are a technologically talented person, China will pay you. They will pay you an almost unlimited amount of
But
money.
he's a big rocket man.
So,
Okay?
do I have instructions where people are supposed to go?
We have some people to escort other
Okay.
Okay. Thank you all so much for coming.